being conducted by the ACCA. This is Lokman Rafiq here, the tutor for this paper APM. We have had the first 4 days of this webinar, and during these first 4 days, what we have done is we have discussed about the major multiple areas of the syllabus. So what we will be doing is, since we head into this final day of the webinar today, so what we would be doing is we would be going through certain areas. I'm assuming obviously we cannot cover up many things in this specific short period of time, but what we have done is we have tried to cover up maximum areas. So if I could just tell you that what have we covered up in the first 3-4 days of this webinar. The first day what we did was we discussed majorly about the performance measurement hierarchy. The second thing is that when we talked about this performance measurement hierarchy, we talked about the critical success factors. We talked about the performance management using the financial performance measures, the non-financial performance measures. We talked about all of these aspects. Then what we did was we moved a bit forward and we attempted one of the examination question that covered up the area of, what did that covered up? That actually covered up the area of the critical success factors, that covered up the area of the measurements of the performance using the financial and the non-financial performance indicators. Then what we did was we moved a bit forward, and the further thing that we did discuss was basically we attempted one of the examination question, and that examination question pertained to balance scorecard introduction. There was another examination question, and that examination question, what it actually pertained to was the performance report. And then we moved a bit forward. In the yesterday's session, we went through the economic value added concept. We discussed the economic value added concept. In addition to discussing the economic value added concept, we attempted one of the examination question pertaining to the economic value added. Also, what we did was we discussed another question which covered up the concept of value-based management. So we have covered up all of these things in our previous sessions. Now let's move a bit forward and discuss further. If anyone has got any queries, anything that you would wish to ask, so do let me know, and or else I'm going to move forward. Yeah, if anyone has got any questions, any queries, anything that you wish to ask, please let me know and I can guide you. Yeah, anyone having any queries, any issues? Okay. Ainola Poida. I'll try. Okay, there is a question, Mohammad Hassan Ali Khan. Your question is, if training costs, marketing costs, R&D costs are all capitalized in EVA, while calculating no patent capital employed, then why don't we depreciate these costs? Okay, basically what happens is the training costs, etc., etc. If there comes a time when you think that they are not going to give you any benefit further, you could just expense them out because it's actually assumed in this EVA calculation that they have got an indefinite life. It's usually assumed that they've got an indefinite life, but then again, it's one of those techniques which is a performance measurement technique, and it could actually change according to your company's requirements and according to your company's assumptions. Because what happens is, when it comes to performance management, it's purely up to you how you wish to deal with the things. These models, etc., they just give you a certain guidance that okay, this is how the approach could be, but they don't actually are something that you must be following each and every specific requirement of that model. Okay, so we are going to start off with the next topic, and this topic is risk and uncertainty. The name of the topic is risk and uncertainty. Now, what exactly do you mean by this risk and uncertainty? Let's try to have certain understanding with respect to the risk. When we talk about the concept of risk, so generally speaking, with respect to the risk, our understanding is that if probability could be assigned to an outcome, if the probability could be assigned to an outcome, that means you are facing a risk. Let me repeat, if the probability could be assigned to an outcome, that means you are facing a risk. And if the probability cannot be assigned, that means you are facing an uncertainty. So when we talk about the concept of risk and uncertainty, so the first and the foremost thing is that what exactly do you mean by risk and what exactly do you mean by uncertainty? When we talk about the concept of risk, risk refers to a situation, risk refers to a scenario where the probability could be assigned to an outcome. That means you could assign a likelihood of the outcome that there is a 25% chance this is going to happen, there's a 35% chance this is going to happen. That means you are facing a risk. The second thing that we discuss is the uncertainty. Now, what exactly do we mean by uncertainty? So if I talk about uncertainty, the uncertainty is basically when no probability could be assigned. Like for example, if I tell you that what is the likelihood that the sales are going to be low, you are like, I don't know. I don't know. Okay. Is there any chance that the sale is going to be low? I don't know. So when you are facing such a situation, that means you are facing uncertainty. When you are facing such a situation, that means you are facing uncertainty. Now, let's try to have a discussion. Basically, what happens is there is a very important aspect which is the decision making under risk and uncertainty. That how exactly do we go about for the decision making under risk and uncertainty scenario. We are now going to talk about this. You see, the first thing is, with respect to a situation where you are facing a risk, you've got a technique which is called the expected value technique. So whenever you are facing a risk, what happens is we use the technique of expected value. I repeat, the expected value technique is used whenever we are facing a risk. And whenever we are facing uncertainty, the techniques that are actually used with respect to uncertainty are the techniques which are termed as maximex, are the technique which are termed as maximin, and the third one of them is termed as minimax regret. So there is this maximex, maximin, and the minimax regret. These are the three different types of techniques that are actually used whenever we are dealing with the risk and uncertainty. So whenever you've got to deal with the decision making under risk and uncertainty, these are the three techniques that you are dealing with uncertainty, and the risk is actually the expected value technique. If I discuss about the concept of expected value technique, so what exactly do I mean by the concept of expected value? The concept of expected value is actually like this. What, for example, assume that you have got multiple expected likely outcomes of sale. The sales is going to be 100 million, there is a 50% chance for it. The sales is going to be 140 million, there is a 30% chance for it. The sales are going to be 200 million, there is a 20% chance for it. So if I use this, and on the basis of this, if I try to estimate the expected sales, the way to calculate the expected sales is going to be 100 into 50% plus 140 into 30% plus 200 into 20%. So the expected sales are going to be what? It's going to be 100 into 50%. Then you've got 140 into 30%. And then what you have is, you have got Yeah, am I audible? नहीं मैं बगैर एंड फ्री हूँ. Yeah, am I audible? Is everyone able to hear me? Okay. Sorry, we lost some audio connection. So really sorry about it. We got a bit of a disturbance in between. Anyways, I'm going to restart from where I was actually explaining to you people. So what we did discuss was, we talked about it that basically risk means that there is a situation where the probability could be assigned to an outcome, and the uncertainty means that no probability could be assigned to an outcome. So when no probability could be assigned, that means we are facing an uncertainty. I told you that with respect to decision making, you have got these different techniques. For the risk, we have got the expected value technique. For the uncertainty, we have got the three techniques of maximax, maximin, and the third one of them is basically termed as the minimax regret. So this is what we have got. Now, then I moved a bit forward and I discussed that what is the expected value technique. So when we talk about the expected value technique, the expected value technique is actually like this, that when it comes to expected value, it's like, for example, you are expected to have sales. For example, you are expected to have a sales of 100 million, and there is a 50% chance that your sales is going to be 100 million. There is a 140 million sale expected to be 30%. Then there is expected to be 200 million, 20%. Now, what actually happens is that once we talk about all of this, if we have to establish the expected sales, we'll do it this way. How? It's 100 multiplied by 50% plus 140 multiplied by 30% plus 200 multiplied by 20%. So how much do we get? 132. Okay. So we get 132 as the expected sales. What do we get? We get 132 as the expected sales. Now let's move a bit forward and discuss about the other techniques. So if I talk about the other technique, let's discuss, let's talk. Basically what happens is, the next technique that we can talk about is the techniques pertaining to uncertainty. For example, you are a company which has a decision to make. You can either go on producing 400 units, you can either go on producing 500 units, or 600 units, or 700 units. This is something that you have to decide. So since this is something that you have to decide, so this is going to be considered as a controllable factor. So I'm assuming that you are a company which has a decision to take, that whether we are going to be manufacturing 400 units of a product in a year, or 500 units, or 600 units, or 700 units. Now, the next step is, you need to understand this thing, that the expected sales demand could be low, could be moderate, could be high. So what happens is, in such a circumstances, if you have to decide that which specific sales figure are we going to go for, so what you need to do is that you need to ideally develop a payoff matrix. Now, what exactly do you mean by this payoff matrix? This payoff matrix would have these columns 400, 500, 600, 700. Now, what next is there? The next thing is, now what next is going to be there? You'll prepare a payoff matrix. The payoff actually means the profit or loss of an outcome. The payoff actually means profit or loss of an outcome. And the sales are expected to be low. The sales are expected to be moderate. The sales are expected to be high. What is actually going to happen is, if there is this 400 units that are going to be manufactured, let's say we have got a profitability situation like okay, the values which are mentioned over here, they may not make sense, but we are not concerned about values, whether the values are making sense or not. We are trying to apply the uncertainty techniques. So assume that this is the company which has to take a decision that how many units of a product should it manufacture in the coming year. How many units of a product it should manufacture in a coming year. And in order to do this, what they have done is they have established that their sales could be what? They have established that their sales could be, their production could be 400 units, 500 units, 600 units, 700 units. They know that the sales are going to be either low, the sales are going to be either moderate, or the sales are going to be either very high. Under the various scenarios, what they have done is they have actually been able to establish that what is going to be a profit or loss under a given situation. So we have the payoff matrix in front of us. What we now need to do is that we need to apply the different techniques. What we need to do is that we need to apply the different techniques to establish that how many units should be produced. So the first technique is Maximax. Now what exactly do you mean by this Maximax technique? The Maximax technique says that you should maximize your maximum payoff. Now, how exactly are we going to do it? You'd say we've got one option 400, then 500, then 600, then 700. So if I try to establish on the basis of 400, the maximum payoff that could be earned is 45,000. On the basis of 500, the maximum payoff that could be earned is 60,000. On the basis of 600, the maximum payoff could be earned is 100,000. And on the basis of 700, the maximum payoff that could be earned is 45,000. The technique of Maximax tells us that you have to maximize the maximum payoff. You have to maximize the maximum payoff. So you have identified the maximum payoffs from each. Now you need to maximize it. So if you are going to be maximizing it, that means this is the one that you have to use. So one of the technique is actually the Maximax. What happens with the Maximax technique is you maximize the maximum payoff. Okay, now the second technique that you need to use is termed as Maximin. Now what exactly do you mean by this Maximin? This actually means you need to maximize the minimum payoff. What does it mean? It means that you have to maximize the minimum payoff. So what you would do is that you would identify the minimum payoffs everywhere. 400, 500, 600, 700. What you need to do is that you need to identify the minimum payoffs. How would we do it? You would say 400. The minimum payoff is negative 45,000. Here it is 50,000. Then 60,000 and then 45,000. So resultingly what happens is on the basis of all this, what we need to do is that we need to maximize the minimum payoff. So maximizing the minimum payoff would lead to this. Okay, yes, my mistake. This is 30,000. But still the answer does not change. But still the answer does not change. Okay, now the third situation is that you have to prepare. The third technique that is there is actually called minimax regret. Now, what exactly do you mean by this minimax regret technique? Let's try to have an understanding. So if I talk about this minimax regret technique, what exactly are we going to do? So I'm going to guide you. Now see, for this technique of minimax regret, for this technique of minimax regret, The first thing that you need to do is that you need to prepare regret matrix. You need to prepare regret matrix. Now, what exactly do you mean by regret matrix? So let's try to understand this. What exactly do you mean by regret matrix? The regret means the opportunity loss. The regret means the total loss. Now, how exactly do we prepare the regret matrix? It's the same manner. That we prepare the normal matrix. Now, what is actually going to happen is, all that you have to do is that you have to now operate horizontally. How? You have to now operate horizontally. And you need to identify the highest, value here. You've identified 60,000 to be the highest. So what would happen is 60,000 less the relevant value. So it would become 40,000. How? 60,000 less relevant value. 60,000 less 50,000 gives you 10,000. 60,000 less 60,000 gives you 0. 60,000 less 40,000 gives you 20,000. Now what next is there? If I talk about the moderate, I know that this is the maximum that could be earned. So it's 100,000 minus 45,000 gives you 55,000. 41,000, 0, 55,000. Then here you have got 80,000. So when you say 80,000 minus 45,000, 80,000 minus 45,000. So what does that mean? Minus 45,000 is minus plus. So this is gonna become 125,000. Now, is everyone okay with this? 80,000 minus 60,000 gives you 20,000, then 0, and then 50,000. So the first thing is you need to establish the regret matrix. Now, what is this regret matrix? These values, they are telling us the regret. These values are telling us the regret. Okay, so what is it showing? It's actually showing you regret. What is it showing you? It's actually showing you regret. Now, what do we mean by this regret? Let's try to understand this. Now, when we talk about the concept of the regret means the loss. Now, how have we established these loss values? Try to understand. Now, for example, if the demand is low, assume that the demand is low. If the demand is low, then how much is the maximum we could have earned? 60,000. How much did we earn? 20,000. So what is the loss? 40,000. Again, demand is low. How much you could have earned? 60,000. How much did you earn? 20,000. So what's the loss? 40,000. Again, how much you could earn? 60,000. How much did you earn? 50,000. So what's the loss? Is that okay to you now? That how do we establish the regret matrix now? So once you have established the regret matrix, what is going to happen next? It's minimizing maximum regret. It's minimizing maximum regret. It's minimizing maximum regret. So you would identify the maximum regret everywhere. And then what you need to do is that you need to minimize the maximum regret. That means again the answer is going to be 600 in this scenario also. Is that okay to you now? Is that okay to you now? Okay. Yeah, is everyone okay with this? Okay, great. So we are now going to move forward and discuss further. Okay, so this is a question in front of you. The name of this question is Turing aerodynamics. The name of the question is Turing aerodynamics. It's one of the past examination question, and it was examined in June 2014. A very good question covering this specific area. So what exactly are the requirement of this question during aerodynamics? It says Turing has formed a joint venture. What does it say? It says Turing has formed a joint venture with Rayman generators in order to design and manufacture high performance So we've got what? We've got this Turing Aerodynamics has formed a joint venture with the Rayman generators in order to design and manufacture high performance wind turbines which generate electricity. The joint venture is called T&R with each party owning 50%. It says Turing will design and build the pylons, housing and turbine blades while Rayman will supply generator to be fitted inside. Now, what exactly is the requirement to the question? It says assess the risk appetites of the two firms in the joint venture and provide a justified recommendation for each firm of an appropriate method of decision making under uncertainty to assess the different types of wind turbines. Now, you need to understand that what exactly are you going to be writing down in the answer to this question. See the question again. It says assess the risk appetites of the two firms in the joint venture and provide a justified recommendation for each firm of an appropriate method of decision making under uncertainty to assess the different types of wind turbines. Let's try to understand this thing. Basically, what happens is there is something which is called the concept of risk appetite. Now, what exactly do we mean by risk appetite? So there are majorly three different types of risk appetites that exist. One of them is an entity which could be a risk averse entity. The second one of them is a risk neutral, and the third one of them is going to be considered as the third one of them is going to be a risk seeker. Now, third one of them is going to be considered as a risk seeker. Now, what exactly do we mean by this? An entity which has a risk averse approach avoids every possible type of risk. Let me repeat. An entity which has a risk averse approach, it avoids every possible type of risk. Whereas the risk neutral entity, what it would probably do is that it would avoid risk to the certain extent, and it would take risks to certain extent. So there is something that could be a risk neutral strategy. And the third one of them is a risk seeking entity, which actually is a very optimistic entity, which actually sees opportunity in every single decision that they take. So you've got a risk averse decision maker, which is more of a pessimistic. You've got a risk seeker, which is an optimistic, and then you've got a risk neutral strategy. Now let's move and let's discuss further. So basically what happens is these are the three different types of risk appetites. You could either be a risk averse, you could either be risk neutral, you could either be risk seeker. Now let's move a bit forward. So an entity which is risk neutral would probably be using expected value technique. A risk seeker would go for a max strategy. A risk averse entity is going to go for maximum. And there's also going to be a minimax regret strategy which the risk neutral is going to adopt. So depending upon how your risk appetite is, how much inclined are you towards taking the risk, this is how your strategies are going to be. So I repeat, depending upon what your strategy is, depending upon how inclined you are, that is what is ultimately going to lead to a situation. That is ultimately going to lead to a situation where you will decide that I'll make my decision using X, Y, Z decision making technique. So if you look at this specific requirement of the question, it says assess the risk appetites of the two firms in the joint venture and provide a justified recommendation for each firm of an appropriate method of decision making. Under uncertainty to assess different types of wind turbine. We will identify which firm is of which category once we have read through the question, but for the time being, this is how you are going to answer this question. The next thing is, it says evaluate the choice of turbine design types. using your recommended methods from part A above. So we have got the option, we have got the opportunity. Let's try to identify that which of the turbine that we should go for. What you have to do is that I'm giving you 5 minutes, 7 minutes time to attempt the question. You've got time till 5:02 p.m. What you need to do is that you need to confirm, you need to try and attempt this question. You need to prepare the payoff matrix, and in addition to the payoff matrix, what you need to do is that you need to apply the relevant decision making techniques. You need to apply the relevant decision making techniques. Yeah, take 5. Oh, have you people even been able to do it? What's the status? I'm assuming you would have done it by now. Yeah, what's the status, please? Any success in doing it, please? Okay, so let's just start discussing. I've got two answers, not more than this two. Why are others not able to understand this? Yeah, the other students not able to understand this. Why is it that I'm getting only two answers? Okay, no worries. Nina, no worries. Hassan Ali Khan, thank you. I have actually read through your answer. Just wait, just give me some time. I'm going to start discussing. It says T&R is run by a group of managers made up from each of the JV partners. They are currently faced with a decision about the design of the product. There are three design choices depending on the power which the wind turbines can generate, measured in megawatts. There is a design type, there is a description. Design type with an 8 megawatt, design type with a 3 megawatt and 1 megawatt. The engineering for the 1 and the 3 megawatts is well understood. So the design is much simpler than for the 8 megawatt, which would be world leading if completed. It says the demand for different types of units will depend on government subsidies of the electricity prices charged by the electricity generating companies who will buy the wind turbines, and the planning regulations for building such large structures. It is believed that there will be orders for either 1,000 or 1,500 or 2,000 units, but there is no clear picture yet on which demand level is more likely than others. We have been given the estimated cost, and the prices for the units are as follows. Variable cost per unit is given, the fixed cost is here. Price per unit, so and so. It says the fixed cost cover the initial design. development and testing of the units. Cost and prices are in real terms with the 8 megawatt unit likely to take 2 more years to develop than the others. What you need to do is that you need to develop a payoff matrix. Now, what is that payoff matrix going to be? We can either go on designing 8 megawatt, we can go on designing 3 megawatt and 1 megawatt. The demand could be 1,000, 1,500 or 2,000. The demand could be 1,000, 1,500 or 2,000. Now, what's actually going to happen is, you would say that we need to establish the price. So how exactly is it going to happen is, with respect to 8 megawatt, the contribution per unit is 10.4. The contribution per unit is 4.8. And there's going to be 4.6 less 1.15. So hence this is going to be 3.45 is the contribution per unit. So what's actually going to happen is, we would say that if 8 megawatt is sold, the demand is going to be 1,000, 1,500 or 2,000. $10.4 into 1,000. Then what happens is, there's going to be fixed cost. The fixed cost is going to be 7,500. So hence resultingly what happens is, this is going to be 2,900. Now, if I go on talking about the 1,500, so there has to be a contribution of 500 more units need to be added up. So it's actually going to be 5,200. And for 2,000, the fixed cost remains the same. You have got additional 500 units that are being sold. Additional 500 units that are being sold at 10.4. So this is also going to be 5,200. So if we add up this 5,200 into it, it would become 13,300. So hence what is going to happen is, you would have 2,900. You would have what? You would have 2,900. You would have 8,100 and 13,300. Kindly complete the table by working out for 3 megawatt and for 1 megawatt also. Can you please just let me know the values of the 3 megawatt and the 1 megawatt? Yeah, can somebody please get back to me with the values? Nina Paradise. Okay, thank you. Just one more answer, please. Yeah, can somebody else can give me the answers of 3 megawatt, 1 megawatt? I just need to reconfirm because I already have it from one student. Okay, so I've got two answers. I'm going to take these answers. So it's actually like 3980. Then what we have is we have 6380, 8780. And then what else we have? We have got 1 megawatt, which is going to be 3090, 4815, 6540. Now, let's use this in order to go for Maximax and the maximum. For the Maximax, you have got 8 megawatt, you have got 3 megawatt, you have got 1 megawatt. It's 13,300. It's 8780, 6540. So if you're going to go for Maximax, then 8 megawatt. If you will go for Maximin, it's going to be what? 831. So you need to identify the minimum value, 2900. So the resultingly answer is, if you have to go for, Maximax, then the Maximax is 13,300, 8 megawatt. Maximin is 3 megawatt, 3980. Okay, let's move a bit forward. Now, the requirement of this question is, it says, evaluate the choice of turbine design types using your recommended method from part A above. Okay, now next, discuss the problems encountered in managing performance in a joint venture such as T&R. Now let's start discussing and going through the question. We now need to actually give two answers. One of the answer is going to be for the risk appetites. The other answer has to be with respect to the problems that you may face while having a joint venture. So now let's just discuss about it. It says Turing Aerodynamics is a joint venture with Raymond Generators in order to design and manufacture high performance wind turbines which generate electricity and so on and so forth. It says Turing is a medium-sized firm known for its blade design skill. It is owned by 3 venture capital firms holding 30% shares. Now let's just see. When Turing is owned by venture capital firms, so this would actually mean that their risk appetite is high. The risk appetite of the Turing venture capital is high, with the remaining 10% being given to management to motivate them. Management is having a vested interest in the shareholding. The VCs each have a large portfolio of business investment and accept that some of the investments may fail, provided that some of their investments show large gains. So what happens is generally the risk appetite is high, but in this specific scenario, they seem to be risk neutral. They're willing to take the risk at a place, but at the same time, they're eyeing for the returns also. It says management is an ambitious group who enjoys the business and technical challenges of introducing new products. So the management has a vested interest and they love challenges. They love challenges and they want to introduce new products. On the other hand, Raymond is a large family-owned company working in the highly competitive electricity generator sector. Rayman is a family-owned business working in the highly competitive electricity generation sector. Shareholders see the business as mature and want it to offer a stable long-term return on capital. Now, what else is there? It says that, however, recently Rayman had to seek emergency refinancing due to its thin profit margins and tough competition, both of which are forecast to continue. As a result, Rayman's shareholders and management are considered for the survival of the business and see T&R as a way to generate some additional cash. So what happens is they are actually somebody who are ideally going to be risk averse. Family-owned business, looking at this business as a mature business. So these are the certain factors. Now, what does it say? It says that unlike at Turing, the management does not own significant shareholding in the company, which has preferred to pay fixed salaries. Fixed salary would mean that there is no risk that they take. It says T&R is run by a group of managers who is made up of JV partners. They are currently faced with a decision of so and so, so and so, so and so. Now, what exactly are we going to do? If you could look at this Turing aerodynamics, they are risk neutral. And if you look at this Rayman generators, they're probably having a risk averse attitude. Yeah, is that okay to everyone? Now, so accordingly, the decision-making technique is going to be discussed and decided. Now let's move a bit forward, discuss further. Yeah, is that okay to everyone? Now, the next requirement to this question is that we have to decide. We are managing the performance in a joint venture. Now, can you please share some suggestions? Can you give some suggestions with respect to the problems that we may face with this specific joint venture? Yeah, please, need your suggestions. Need your suggestion, need your input for this, please. Yeah, please. Any suggestions? Okay, good, 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 good. More suggestions needed, please. Yeah, am I audible? Okay, now let's just see. So what we have got is we have got different answers, we have got different suggestions. So let me read through the suggestions and let me read through the answers. Now you see what happens is both of these partners, what happens is both of these partners, there are two different types of partners. This Rayman generator is a family owned business. They don't want to take risk. They are basically risk neutral. They would wish to take the risk. There are going to be issues which could be the with respect to the culture, with respect to the exit strategy, which could be with respect to which could be with respect to the objectives and the goals. So there could be all these multiple issues that could actually arise with respect to such type of a joint venture. Why? Because when you have a venturer, you can't just decide everything on your own. You have to have the venturer's decision. You have to have a venturer's decision alongside you, and on the basis of venturer's decision, you people can move forward. So resultingly, this would also lead to a situation where the decision making process will slow down, where the decision Yeah, is that okay now? Okay, great. So what we have done is we have gone through this specific question, the name of which is Turing aerodynamics. What was the name? It was Turing aerodynamics. So we are now going to move a bit forward, and the next topic that I will be discussing now is basically I will be talking about the transfer pricing scenario. What I would be doing is I'd be talking about a transfer pricing scenario. Let's have a discussion. Let's talk about this transfer pricing scenario. But before we go on discussing this transfer pricing scenario, I will have a short break. This short break is going to be till 50 p.m. So we'll have the short break till 5:50 p.m. Once we resume after the break, we will go for the transfer pricing scenario. We'll go for the transfer pricing scenario after the break. And then what we are going to do is that I would try to have another question on the ABM, the activity based management. So we are going to start off again at 5:50 p.m. I'm taking a short break for the prayers, and this is my number in case if any one of you wishes to get in touch. Okay, so let's just start off. Let's just start discussing about the next aspect. I'm going to start discussing about transfer pricing. I shared with you people the notes also pertaining to this APM, and there were many areas, there were many things that were covered into this notes. So let's have a quick discussion about this divisionalization and transfer pricing. If I talk about the concept of divisionalization, I think you people have a good idea about what divisionalization is. Divisionalization simply means when you split an organization into multiple parts, and each of the part is an autonomous part. So whenever you split an organization into multiple parts and each of the part is an autonomous part, that means you have actually created divisions within an organization. There are multiple advantages, there are multiple disadvantages for the divisionalization. One of the major advantage of divisionalization is a quicker and the better decision making, and also the senior management can focus on its core business. Amongst the disadvantages, there could be a duplication of function, which obviously happens because you have got multiple production department, you've got multiple finance, so on and so forth. There could be dysfunctional behavior, that is the goals of the employees are not aligned, are not aligned. So there could be this situation also. When it comes to divisionalization, so there are multiple ways of measuring a divisional performance. And what are those multiple ways? One of them is called the ROI, which is the return on investment. What exactly do you mean by return on investment? It's simply the divisional profit divided by investment into 100. It's a modified version of return on capital employed. So what we generally do is that we calculate return on capital employed. The modified version of return on capital employed is return on investment. The next thing is residual income, which we did discuss while we were discussing about the economic value added. So we do know that this actually gives you a result in percentage terms, and this gives you results in absolute terms. That means it provides you result in terms of dollars, and you have to decide whether your business is performing well or not by using this specific dollar terms or not. At times what happens is, what you could do is that you could measure the performance of a division using the standard costing and the variance analysis also, and this is usually relevant when it comes to a cost center. At times what happens is, when we are calculating the performance of the business, it's always good to use the controllable profit rather than divisional profit. Now what exactly do you mean by controllable profit? So for example, if there is the sales and the expenses and let's say overheads allocation, and then you get the profit before tax and so on and so forth. So what could probably happen is there may be a situation that this overhead is a centrally allocated overhead and the divisional manager has nothing to do with it. So if you have to establish the controllable profit, the controllable profit could be established like this. You can have the profit before tax and you could add up the overheads to it. You have the profit before tax, and what you could do is that you could add up overheads to it. So those expenses which are basically beyond the control of the manager, you need to add them up. Then there is this economic value added, which we have already done. There are multiple divisions in an organization, and usually it becomes quite difficult to measure the these different divisions. What could be the multiple reasons? One of them could be the different working conditions, like the work culture, the geographical location, that is the area where they are situated in, the investments, etc. The scale of operations, the size of the operations also matter. I'm repeating, the size of the operations also matter. And the third one of them is a different regulatory environment. The third one of them is a different regulatory environment. Basically, it actually depends upon what sort of regulatory environment are you operating in. So that's the regulatory operating environment. What is going to happen is that is also going to have an impact upon how our division operates. So when you talk about the divisionalization, so you need to understand that when it comes to measuring the performance of our division, these are the multiple things that you would have to keep in mind. Now let's move a bit forward. Let's discuss further. If I move a bit further and if I talk about the concept of transfer pricing, so what exactly do you mean by transfer price? Let's try to understand that. The concept of transfer price is basically the price at which goods or services are transferred or supplied from one division to another division. So the price at which the goods or the services from one of the division is transferred to another division, that price is going to be termed as a transfer price. So let me repeat, what is the transfer price? The transfer price is the price at which the goods or services are transferred from one division to another division. Now what next is there? It says that a good transfer pricing in any organization will aim to achieve the following objectives. What are the objectives? First of all, it will facilitate performance evaluation. Now, let's try to have an understanding. You can have the organizations, and the organizations could be like this, that you've got one of the department which is a cost center, one of them is a profit center, one of them is a revenue center, one of them could actually be um, the investment center. So let me repeat, there could be multiple types of departments. The profit center, cost center, revenue center, etc., etc., etc. There could be multiple types of departments. That's how things could operate. So depending upon how your organization is, let me repeat. The transfer pricing policy should be in line such that it is able to facilitate the performance evaluation. Now, what's the second thing that you need to keep in mind? Let's move a bit forward. The second thing is to motivate the divisional managers. The pricing should be such that none of the managers get demotivated. None of the managers get demotivated that what exactly is happening with that specific manager. Now, what next is there? The next situation is basically maintaining of the divisional autonomy. Maintaining of the divisional autonomy, that the divisional autonomy should not be compromised. The divisional autonomy should not be compromised. Now, what next is there? The third thing is that the goal congruent behavior should be promoted. Then it should be such that it should minimize the taxes. The profits are transferred from the jurisdiction where there is a high rate of tax to the jurisdiction where there is a low rate of tax. So that could also be done. That the profits are transferred from a jurisdiction where there is a high rate of tax Now what next is there? The next situation is that what are the different types of transfer pricing policies that the organization could adopt. So one of them could be a cost-based transfer pricing, which could have multiple variants like full cost, variable cost. So one of the cost-based transfer pricing strategy could be adopted. When you use the cost-based transfer pricing strategy, there are obviously certain advantages, certain disadvantages that you have to face when it comes to using this cost-based transfer pricing policy. Now, what next is there? The next situation is basically you can have a negotiated transfer pricing. Now, what exactly do you mean by negotiated transfer pricing? So when I talk about the concept of negotiated transfer pricing, the negotiated transfer pricing would actually mean what? The negotiated transfer pricing would be like you've allowed the people to negotiate, you've allowed the people to bargain on their own with each of the you have allowed the department, you've allowed the people to bargain with each other. That is actually considered to be a negotiated transfer pricing strategy. Now, what next is there? The third one of them is basically the market-based transfer pricing, where what happens is the divisions are asked that what you need to do is that you need to transact amongst yourself at the market-based price. That whatever the price that is prevalent in the market, you have to transact amongst yourself using that specific price. What you have to do is that you have to transact amongst yourself using that specific price. Now, at times what happens is there is an adjusted market price that is used. What is this adjusted market price? The difference between the market-based transfer price and the adjusted transfer price is that you use the market value, but then what you do is that you actually bring about the adjustment of the cost saved by selling internally, of the cost saved by selling internally. What you do is that you actually is that okay to everyone? Now, let's move a bit forward. And on the basis of that question, what we would be doing is we'll be discussing how the transfer pricing is actually dealt with. You are being provided with this question. The name of this question is a Landwell lamps. The name of this question is Landwell lamps. Uh, let's just start discussing about this question, Landwell lamps. So what I would want you people to do is to try to go through this question, try to understand the requirement, and try to attempt this specific question. Take 5 minutes, Landwell lamps. Okay. Now let's start discussing about this question, Landwell lamps. It says Landwell lamps manufactures and delivers floor and table lamps for homes and offices in VLAN. So what does it do? It manufactures and floor and table lamps for the homes and offices in VLAN. It says the company sells through its website and uses commercial logistic firms to deliver their products. The markets for its products are highly competitive. Now, what happens is, it says the company has traditionally relied on the high quality of its designs to drive demand for its products. So you are being told with respect to about this Landwell lamp is that, let me repeat, what you are being told with respect to the Landwell lamps is that the Landwell lamps is one of those companies which has been manufacturing and which has been delivering the table and the floor lamps for homes and offices in B-lands and so on, so on. Now, the company is divided into two divisions. One of them is a component division and the other one of them is a assembly division, plus the head office that provides design and admin marketing support. So you've got a component division, you've got an assembly division, plus a head office that provides design, admin, and marketing support. Now, what happens is, if we talk about it, so it's actually going to be like this. You've got the component, you've got the assembly, and you've got the head office. The components division making the housing components and electrical components for the lamp. This is an intricate process as it depends on the specific design of the lamp and to serve as a significant source of competitive edge for Landwell. So what it does is that the housing and the electrical components, they are being designed. The housing and the electrical components, they are being designed. Now, what next is there? The next situation is, it says the assembly division assembling the various components into finished lamp ready for shipment. This is a simple process. So you have got, they prepare it for shipment. Now, it says the finance director of Landwell is currently overloaded with the work due to changes in the financial accounting policies that are being considered at board level. So what is the finance director? He is currently overloaded with the work due to changes in the financial accounting policies that are being considered at the board level. As a result, she has been unable to look at certain management accounting aspects of the business and has asked you to do a review of the transfer pricing policy between the components and the assembly division. So what has actually happened is, we are being told that the finance director is currently overloaded with the work due to changes in financial accounting policies that are being considered at board level and so on, so on. Now, so what we are being told, she has been unable to look at certain management accounting aspects of business and has asked you to do a review of the transfer pricing policy between components and assembly division. So what we need to do is that we need to review the task that has been provided to us, is that we have to review the transfer pricing policy between component and assembly division. Now, what else is there? It says the current transfer pricing policy at Landwell is as follows. Market prices for electrical components are used as these are generic components for which there is a competitive external market. Okay. So what it does is that the electrical components are being used at the market value. Why? Because they are more of a generic sort of things. What else is there? Prices for housing components based on total actual production cost to the component division are used as there is no external market since they are specifically designed for Landwell's product. and for the housing components, what happens is the actual cost. For the housing components, what happens is the actual production cost is being used. Now, what else is there? Let's try to understand. It says currently the components division produces only for the assembly division in order to meet overall demand without the use of external suppliers for housing and electrical components. What does it tell you? It says currently the component division produces only for the assembly division in order to meet the overall demand without the use of external suppliers for housing and so on. If the component division were to sell its electrical component, then additional cost of this much would arise for transport, marketing, and bad debts. So what happens is the savings due to selling internally is 269,000. What else is there? It says the FD is considering two separate changes within Landwell. One to the transfer pricing policy and a second one to the divisional structure. Okay, so what they are doing is there are proposed changes. One of them is to the transfer pricing policy, and the other one of them is going to be one of them is for the transfer pricing policy, and the other one of them is going to be for the divisional structure. Now, what exactly are they? It says first, the transfer pricing policy for housing components would change to use variable cost to the component division. What would happen is the transfer pricing policy for housing components was changed to use variable cost to the component division. So what happens is housing components, you are now going to be charging variable cost only. The FD wants to know the impact of the change in the transfer pricing policy on the existing results of the two divisions and the company. No change is proposed to the transfer pricing of electrical components. So what he wants to do is that he wants to see the impact on. He wants to see the impact on results of two divisions and the company. The second one of them is, it says, as can be seen from the divisional performance report below, the two divisions are currently treated as profit centers. FD is considering splitting the component division into further separate divisions in electrical component and housing component. Then it says, if the board agrees to this proposal, then the housing component division will be treated as a cost center only. This is going to be treated as a cost center only. And charging its total production cost to assembly division. To the assembly division. And the second thing is that it says the electrical components and the assembly division will remain as profit center. FD needs to understand the impact of this proposed new structure on divisional performance, assessment, and on company as a whole. She has asked that in order to keep the discussion on new divisional structure simple, you use existing transfer pricing policy to do illustrative calculations. She stated that she would reallocate head office costs to the two new components in proportion to their cost of sales. Now, what exactly are this? We are being provided with the financial and other information for Landwell lamps, for component division, for assembly division, for Landwell lamps. The next thing is, it says the component division has had problems meeting budgets recently with an adverse variance of 575,000 in the last year. This variance arises in relation to cost of sale for housing component production. So now what it does is, it says evaluate the current. What is that? What it does is it says evaluate the current transfer pricing at Landwell using illustrative calculation as appropriate. Advise on the impact of changing the transfer pricing policy for housing components as suggested by FD and comment on results. Evaluate the impact of the change in the divisional structure. Now, if you read through the requirements of this question, it's next to impossible. It's next to impossible to answer the question. Let me tell you. If you read through the requirement of this question, it's next to impossible to answer the question. Why? Because the question is very much ambiguous. So how exactly would be able to understand? We would be able to understand only when. We would be able to understand only when we would go through it this way. We would read through the question content. The question is actually explaining what the examiner wants. Yeah. So how exactly are we going to answer this question? The first requirement of the question was, well, this is a past examination question, Subin John. You can expect anything. So now let's just see this thing. Basically, if you look at the first requirement, it says evaluate. Evaluate means comment, means judge, means you need to discuss the current system of transfer pricing at Landwell using illustrative calculations as appropriate. Now, what are we going to do with respect to it? The first thing is, if I talk about this Landwell lamps, what actually happens is, the electrical component division sells the good at the market value, which is a correct approach because it's a generic product and a market exists. So this is a good aspect of the transfer pricing. But the assembly division could argue. What could be the argument from the assembly division? The assembly division could argue that they are saving while selling to us. So hence, it just should be an appropriate approach. The adjusted market value should be an appropriate approach. So instead of selling at how much are the sales of the electrical division, by 7, they should sell at 1557 less 269. So now hence what is actually going to happen is 1288 should be the suggested selling price for the electrical components. Is that okay to you people? Is that okay to you people? Okay. With respect to the current transfer pricing, if we talk about the electrical component division, this is what should be done. Now, the next thing that you need to keep in mind is that with respect to the housing components, external market, then the cost-based transfer pricing is correct. But the housing component division, which probably generates 8204 here, Okay. So now let's discuss further. Basically what happens is the housing components does not have external market, therefore cost based transfer pricing is okay. But you see the housing component division, what happens is it would have been good if this specific component would have actually got a cost plus strategy, like maybe cost plus, let's say 10%, 20%, 30%, etc., etc. Whatever the profit margin of the business is. What is the profit margin of Landwell Lamps? What is the profit margin of this whole company, Landwell Lamps? It's 2641 divided by 15794. It's approximately 16%. If I try to establish the cost of sales of this housing, so I'd say 6902 plus 8204. It's gonna be 15,106. Sorry, it's 8204. Now, if it is 8204 out of the total 9761, so I could just say that this is approximately 84% of the cost. So basically what could possibly happen is you can have this cost plus 10, 20, 30, maybe even let's say cost plus 16%. That could be the approach that you could use. Also, the problem that is arising is the full cost is being transferred and there is a cost adverse variance that is arising. There is a cost adverse variance that is arising. So if there is a cost adverse variance that is arising, what is happening? This is something which is not acceptable. This is something which is not going to be acceptable. Now, if this is something which is not going to be acceptable, so what exactly are we going to do with it? How exactly are we going to deal with it? Now, so in order to understand this, what you need to do is that you need to make sure that what is actually going to happen is the cost adverse variance also exists. So what is advisable? What is advisable is that rather than allowing them to charge full production cost, you can allow them to charge the budgeted cost plus a certain percentage of markup, let's say 20%. So if we apply the changes that we have suggested, so on the basis of the changes that we have suggested, what is actually going to happen is, try to understand this. If we try to apply the changes that we have suggested, so on the basis of changes, what is actually going to happen is, you'll have the profit and loss account, which is going to be like this. This sales is going to change. 1288. This is going to change. 1288. This housing component sale could be 6902 as a cost. Then there is this fixed production cost, which is 1302. So gives you 8204. What you could do is that you could say 8204 into 1.2. Maybe what could happen is you can have 9845. So hence what happens is 1288 plus 9845 gives you 11133. This remains 804. This remains 6902. This remains 370. This remains 1302. What actually happens is you have got 11133 minus 804 minus 6902 minus 370 minus 1302 makes it 1755. Then the allocated overheads, which is 461. So hence resultingly what happens is we have got a profit of what? We have got a profit of 1294. This would remain 15794, but this would become 9845. This 2046 remains the same. So resultingly the profit is going to be 15794 less 1288 less 9845 less 2046 gives you 2615. And hence this is going to be 15794. This is going to remain the same. 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 This is something that you could probably do with respect to it. Is this okay to everyone? Yeah, is it okay to you people? Yeah, I need your feedback, please. Is it okay to you people? Okay, coming back to it. Are you okay with these suggestions, these evaluation? That for the electrical component market value is okay. We would have been better off if we would have used the adjusted market value. Is this okay? I mean, is this understanding okay with respect to the electrical components? Okay, now let's move a bit forward. For the housing components, since there is no external market, then cost seems to be okay. But the problem is you could have actually added up some margin to it. You could have added up some margin to it. So when you would have added up some margin to it, so result would have been what? If you add up some margin to it, the result would have been that these housing component people, they would be very happy. What should be the margin? I've calculated the existing P&L, and it's actually okay. We are just suggesting that you should prefer to have cost plus strategy rather than only having the cost based strategy. You should prefer to have a cost plus strategy. Is it okay now? Okay. Now let's move a bit forward. So what I have done is I have actually calculated that based on the suggestions that we are giving them. Based on the suggestion that we are giving them, this is what the whole pricing is going to be. Okay, the next step is basically how did we get the 9845? Okay, we got the 9845 this way. 6902 was one of the cost, 1302 was another cost. I added up both of them and I multiplied it with 1.2. Firanmi Williams, are you getting it now? Yeah, that is the margin. That is the margin. Yes, I have added 20% to it. Now, the next part of this question is, it says advise the finance director on the impact of changing the transfer pricing policy for housing components as suggested by FD, and comment on your results using illustrative calculations as appropriate. Now, we just need to see what is the suggestion. We just need to see what is the suggestion. So if you could look at it, the suggestion that the finance director has provided is like this. He says that the transfer pricing should be to charge variable cost to component division. Should be to charge variable cost to component division. So what is actually going to happen is, now what you could do is that you could say that if a change in the transfer pricing policy is suggested. What if a change in the transfer pricing policy is suggested? How exactly are the things going to move? Now let's see. The electrical is going to be the way it is. The sales of the housing division is going to be based on the variable cost, which is 6902. So hence what happens is, this is going to be 1557 plus 6902 gives you 8459. Then you've got 804, you've got 6902. So the subtotal becomes what? 753. Then you've got 370, you've got 1302. So resultingly what happens is there's going to be 919, and there is 461 head office cost. So hence this would run into further loss of 1380. It would run into a loss of 1380. Now let's move a bit forward and discuss further. The next thing is this is going to remain the same. This is going to remain the same. This would become 6902. So hence what happens is 15794 less 1557 less 6902. There's going to be 7335. And you deduct this 1268 here, you deduct 2046 here. There's going to be 4021. The overall profit of Landwell lamps isn't going to change. Why? Because we are being provided that the suggested policy is that the components division should now change. To a policy that it only charges the variable cost. Now, you see, if a scenario like this is happening, that means what is happening is you are degrading the component division. You are degrading the component division. It produces unique product, and that product isn't provided the appropriate value. This would demotivate them, could have an adverse impact upon overall sales of entity. So this is what is going to happen. Yeah, is it okay now? Is it okay now? on to the third requirement of the question. It says, evaluate the impact of the change in the proposed divisional structure on the profit of the divisions and the company as directed by the FD. So what is the proposed changes to the division? It's actually separating these divisions, and by making this housing division to be a cost center, the electrical components to be the same, the assembly to be the same. So now let's just try to have an understanding of this. What's going to happen now is, you would have this as, let's say I'm naming it is electrical components division. This is going to be removed. This is going to be removed. This is going to be removed. The allocated head office cost has to be rearranged. The housing component division would now be selling at what? Would now just be a cost center. That means it's not going to be making any sales. So the costs of sales are going to be 6902. The fixed production cost remain 1302. The allocated head office costs are going to be what we just need to establish. So the head office cost overheads that were supposed to be allocated were what? 461. Of this 461, housing component and the electrical component. The housing component is going to be what? The cost of sale is 6902 upon 7706 multiplied by 461. For the electrical component, it's going to be 804 divided by 7706 multiplied by 461. You would say, why exactly are you doing it? We are doing it because we are being told that it has to be allocated on the basis of relative cost of sales. So hence, this is actually going to be approximately 413. And this is going to be approximately 48. This is 413 and this is going to be 48. So resultingly what happens is, since all of this is cost, so this is going to be a loss making division of 8617. This division would have what? 1557 less 804 less 370 less 48 gives you 335. This would remain unchanged, this would remain unchanged. Now, if we could just sum up what we have discussed, we have actually been able to identify that by doing this is what is going to be happening. So what is going to be the advantages of this? This would actually tell you that what is the electrical component itself generating. The assembly division remains the same. The housing component, it's a bit demotivating for the housing component that they are being converted into a cost center. It's a bit demotivating for the housing division that they are being converted into a cost center, because they are the main source of revenue for the whole entity, and they are being treated just like a call center, as a cost center, which probably is of no use for the organization. So it could have an adverse impact on the division's motivation. So basically, if I sum up this specific question, the requirement of this question were quite difficult to understand, but once you go through the question itself, the requirements are explained in the question itself. So that made the question to be quite easier to solve and understand. Otherwise, it would have been a very difficult task to handle this question. Okay, now. Now what I am going to do is that we can stay connected and I can help you out preparing for this APM. I can help you boost up your preparation for the APM till the exams. And this question is, I think, 2013-14. I can help you continuously prepare for the exam. And what I would suggest is that we stay connected through the WhatsApp group, where you can get information, where you can get assistance. I know it was a bit of a disturbed session today because of poor network, but still we managed. I know there were a bit of a disturbances. There were several times that the screen froze, several times that the audio actually was lost, but still I believe that we managed to get approximately 90% of the session correctly. So that's it for today. Thank you very much, everyone. I would really appreciate your feedbacks and suggestions so that we can take it up from there. Mohammed Kayum, I will, inshallah. Mohammed Kayum, I will. Fernami, I will. Subin John, thank you very much for your feedback. So thank you very much, all of you, for attending. Thank you for your feedbacks. Thank you for your suggestions. Wish you all the best. Buzz me in case if you have got any issues. I'll try to respond back to you people as quick as possible, inshallah. Thank you, Muhammad Samad. Thank you, MD Samad.